The average American carries 4 credit cards. Most of them believe they are winning. Free flights, free hotel stays, cashback landing in their account every single month. It feels like the banks are giving money away. But no company hands out billions of dollars a year without getting far more in return. In 2023 alone, credit card companies and banks paid out more than $30 billion in rewards to customers in the United States. And yet, during that same year, those same companies posted record profits. So the real question is not how are they losing money on rewards. The real question is what are they winning that is worth so much more. To understand this, you have to stop thinking of a credit card as a piece of plastic. It is a payment network sitting between 3 players who all need each other. There is the customer who wants convenience and perks. There is the merchant who wants to sell products without losing customers to competitors who accept cards. And there is the bank, sitting in the middle, quietly collecting a small percentage of nearly every transaction that flows through its system. That small percentage is called an interchange fee, and it usually sits somewhere between 1 and 3% of every purchase. It sounds tiny, but multiply that by trillions of dollars in annual card spending, and the number stops looking small at all. Here is where the story gets interesting. A portion of that interchange fee is what actually funds the rewards program. When your card gives you 2% cashback, the bank might be collecting close to that same amount or more directly from the merchant. In other words, rewards are not a gift. They are a redistribution. The bank takes a cut of your spending, gives some of it back to you as an incentive to keep spending, and keeps the rest for itself. The more you use the card, the more everyone in this chain gets paid, except for the merchant, who often has no real choice but to accept cards or risk losing customers altogether. But interchange fees are only one piece of the puzzle. The bigger prize is behavioral. Rewards programs are engineered to change how people spend, not just where they spend. Studies have shown that consumers spend measurably more when using a credit card compared to cash for the exact same purchase, sometimes by 12 to 18%. That is because a card removes the psychological friction of watching money physically leave your hand. Rewards make that friction disappear even further. If every purchase feels like it is earning something, spending starts to feel like a decision with no downside. That is exactly the illusion the banks are counting on. And then there is the part of the business that rarely gets mentioned in commercials: interest. If a cardholder pays their balance in full every month, the rewards program is genuinely a good deal for them. But most people do not. Around 40% of credit card holders in the United States carry a balance month to month, and the average credit card interest rate has climbed above 20% in recent years. For someone earning 2% cashback but paying 20% interest on an unpaid balance, the math turns against them fast. The rewards were never the real product. They were the marketing hook. The real product for the bank is the interest that follows when the habit of spending outpaces the discipline of paying it off. This is why premium travel cards charge annual fees of $500 or more, and people happily pay them. The perceived value of lounge access, hotel status, and airline miles is often worth far more emotionally than it is financially. Airlines and hotel chains benefit too, selling miles to banks in bulk, sometimes generating more profit from selling points than from selling actual seats or rooms. It becomes a closed loop, where everyone in the system profits from the illusion of a free reward, funded quietly by the small percentage skimmed from every swipe and the interest paid by those who fall behind. So who really wins in the business of credit card rewards? The disciplined spender who pays in full every month captures real value, essentially getting merchants and banks to subsidize their travel and purchases. But they are the exception the system tolerates, not the customer it is built for. The business was built for volume, for behavior, and for the portion of cardholders who spend a little more than they intended and pay a little slower than they planned. The rewards are real. The free flights are real. But nothing in this industry was ever free. It was simply paid for by someone else in the chain, often without them even realizing it was them.